Hello and welcome to Sifter Fund's quarterly results review. In this presentation, I will walk through the fund's performance in the second quarter and introduce a few of our companies and their outlook. And finally, I will share which stocks over and underperformed during the second quarter. The year began with a sharp decline in share prices, and the first quarter ended with a 6.4% decline for the fund. Many hoped that the drop in share prices would be over and the market would rebound. However, the opposite happened. The stock market continued in a negative mood with high inflation numbers, rising interest rates and many other macroeconomic factors. The second quarter decline was 11% and from year to date the fund has declined by 16.7%. So, should one sell or buy equities now is up to investors' own investment strategy. Sifter Fund's key principle is investing in business returns and not in share price movements. Even though it sounds simple, in practice it's quite difficult. For example, many investors lose their focus during the downturn and only follow the falling stock prices. In the investment strategy of the Sifter Fund, roughly 80% of the time and investment criteria relates to the business fundamentals, meaning the earnings model, competitive advantages and the money-making power of the company in question. Only 20% of the investment requirements are related to the share price valuations. We believe that over a 5-year time frame, investing in companies where the money-making power is growing is much more important than succeeding in buying a stock at the discount or at the bottom of the market. The down market also offers opportunities to make changes to the portfolio. Let's see next what changes we have made. During the second quarter, we invested in 2 entirely new companies. The other is Walt Disney, invested in April, and the other is West Pharmaceutical, invested in June. We believe those companies' business results are predictable and not too dependent on raw material prices or global production bottlenecks. In addition, we see that Disney, for example, and Pharma as well, expectations are higher than those we sold out of the portfolio. In addition to those new companies, we increased the weight of few existing investments in which we see storm resistance and reasonable return in a market like this one. For example, we slightly increased the weight of the Canadian retail company called Northwest Company because the demand for the company's products is stable and the dividend yield is high and predictable. We also increased the weight of the existing Safran investment, which makes a significant part of its earnings from the engine maintenance contracts. Let me share a few words about the most recent investment, which is a US-based company in pharma sector. The company in question is called West Pharmaceuticals. West is a drug packaging company that designs and manufactures the rubber products you find for example, in drug vials and syringes. It's a business where the quality of the product is crucial for the safety of the drug, but the rubber products themselves are a small fraction of a total cost of a drug. The main growth driver stems from the pharmaceuticals industry, turning towards biological drugs to treat age and life cycle related diseases, such as cancer and autoimmune diseases and diabetes. The rise in biologic drugs sales drives demand for the West high-value offerings. In a summary, we invest in West because it's the dominant and highly profitable pure-play company in a growing market with a high entry barriers. In order to invest in West, we had to divest remaining portion of our Starbucks investment in this quarter. Starbucks was the portfolio company we invested in 2018. The reasons for the divesting are very much according to Sifter investment strategy. First, we see the company is most affected by the inflation in wages and higher cost in transportation and raw materials. This will lead to a decline in margin in our view. On top of this, employees of this company started to unionize, and in our view, the Starbucks management is not responding well to this change. We have additional concerns about this management as the former CEO left and was temporarily succeeded by the original founder, who is currently looking for a permanent replacement. And the last concern we had with this company Was it China operations, which represent the future growth for the Starbucks? China has been heavily affected by COVID lockdowns, and this has impacted these companies negatively. We see risk in the future performance of this growth story as we don't have data on how Chinese customers change their coffee spending habits in a possible future of recession. Finally, let's see which Sifter companies overperformed and underperformed in the second quarter, and maybe a few words about those companies if you allow. The biggest gainers in share prices in the second quarter were Johnson & Johnson, Novo Nordisk, and surprisingly, Autoliv. Johnson & Johnson has steadily grown and also increased profitability, mainly thanks to its strong pharmaceutical business. This business has historically been very resilient during crises as well. The financial crisis, COVID, and the current macro uncertainty environments are no exceptions. The share price increase may thus reflect the Johnson & Johnson's as seen as a safer haven than other equities. We see that the Johnson & Johnson will continue to its steady growth thanks to its pharmaceutical segment. The second gainer is also from the pharma sector. It's Novo Nordisk. The company has continued to perform well, and its new and superior diabetes care products are gaining market share across the world. In addition, the newly launched weight loss drug, which is the first effective drug for reducing obesity, has continued to outperform and surprise the market. We think Novo Nordisk has a clear growth path and will continue to be the dominant diabetes care company for the foreseeable future. The third biggest gainer in this quarter was Autoliv, which is a global market leader in passive safety devices for cars. The light vehicle production has been faced with a tough supply chain uncertainty due to raw material price inflation, lockdowns in China, and Russian invasion of Ukraine and the semiconductor shortage. However, Autoliv's management has worked to renegotiate its contracts to reflect this new environment and sought closer collaboration with the customers to gain clarity for its short-term production operations. These initiatives have been successful, and Autoliv reiterated its guidance for 2022 in late June, alleviating concerns about downside potential and causing the stock price to rise. The timing of when light vehicle production will return and surpass 2019 levels is still unclear for many. But we see that Autoliv's strong competitive position and financial health will allow it to benefit from the eventual rebound. And finally, a few words about these decliners in this quarter. We have Nitori, VeriSign, and Universal Music Group. In the second quarter, the Japanese home fashion giant Nitori reported disappointing same-store sales growth, which remained below the pre-COVID trend. The company is also showing a lack of pricing power as it attempts to cut prices while raw material costs are rising. Nitori's problems are compounded by the Japanese yen, which depreciated by another 10% in second quarter, putting further pressure on Nitori's import-driven business model once the company's currency hedges expire. Nitori has long reported leading profit margins in its home market, and the company has unrivaled scale in Japan, as well as extensively integrated supply chain. These features should help Nitori to weather cost pressures, but overall we are not satisfied with the company's performance, and we decrease the weight of Nitori holding in our portfolio. VeriSign, the US company, owns and maintains the world's most famous internet domain services called .com and .net. We have owned VeriSign stock for over 7 years, and few quality companies have been as predictable as VeriSign. However, in this quarter, the company announced to reduce the top of the guidance range for the next quarter, which left some investors disappointed. In our view, the number of domain names will, however, continue to grow at around 2.5% per year, and the company can raise prices by 7% per year. We think VeriSign is a very quality business. In June, Universal Music Group's short-term growth prospects diminished somewhat as Spotify signaled that it aims to reduce hiring by 25%, which reflects concerns about recession and its potential impact on the music industry. While slowing growth in the music streaming market would be a headwind for UMG, the company would still remain a critical partner for music streaming services. UMG holds rights to a vast amount of popular music and it earns its share of the monthly subscription income collected by the streaming services. We have increased the UMG position a little bit. So in conclusion, the past 6 months have been a challenging time for equity investors. When we look at the results of our companies, it's a little difficult to understand why share prices have suffered so much. Of course, the company's predicted results may worsen and thus correspond to the decreased valuation levels. Well, our task is to closely monitor the development of the company's money-making ability in the future and, if necessary, replace the companies in the portfolio with even better ones. Have a great summer and thanks for joining us.